Welcome back to Small Caps, and I can still continue to say Happy New Year because it's January. And today I'm bringing you Niv Dagan. He is the founder and executive director of Peak Asset Management. Now, why am I doing this? Well, we're heading into 2022, and this investment landscape is constantly changing. It's evolving. I get a lot of questions from people saying, what's the outlook like? What are we going to be seeing in 2022? So I thought, better get Niv on, because not only does Peak Asset Management look at a lot of companies, but they look at the bigger picture as well. So they back strong boards, and they like boards that have got strong management and going to give back, gives shareholder value, which is what we're all looking for, isn't it, ladies and gentlemen? So Niv, Happy New Year. Welcome to Small Caps, and great to see you.
Happy New Year, Kerry. It's great to be here. Hope you had a fantastic break.
A little bit of a break, and it seems to go very, very quickly. And here we are in 2022, still grappling a little bit with supply chain shortages and a few other challenges, which we will get into in the conversation. But before we do, Niv, for those that might not know who Peak Asset Management are, first of all, a little bit of background about you. You've had some, I know you've had some time with Macquarie Bank and in the securities. Why you founded Peak and who you are.
Yeah, question. So Peak, I mean, my background, firstly, Kerry, is institutional. So I started at Macquarie Bank on the institutional side of the business, worked predominantly with fund managers, asset managers, larger groups of clients. In 2010, towards the end of the GFC, left to pursue an opportunity to run HC Securities, which is a boutique investment management and corporate advisory business. I grew that business up. That business was sold, and I set up Peak about 8.5 years ago. So it's been a whirlwind opportunity for Peak. I mean, our entire model, for those that don't know, is all about co-investment. What I mean by that, our job is to find curated deal flows that traditional investors can't get access to themselves, that we back with our own capital. Predominantly placements, IPOs, pre-IPOs, and we try to help these companies more than just capital. So capital is one angle, but if we can help them with joint ventures and partnerships and opening up doors and help them with the pitch decks and getting it out to our 30,000 investors, that's how we add value. Remember that every opportunity that lands in our investors' inbox, we have to take a big position in ourselves. So it's really important that we're 100% aligned and we're adding alpha and making money for the end client.
I think that's wonderful, because for those that are out there, you know what, they're putting their money where their mouth is and then offering it up to you guys and saying, listen, we've found an opportunity. Here it is. If you'd like to invest, here's an opportunity. But they're not doing it at arm's length. They're actually putting their own money in, which I think gives you a little bit more, I guess, confidence, because you've clearly done the work, you've done your due diligence, and you feel pretty strongly that this could, and, you know, they're not 100% winners, but that's the life that we're living at the moment. So it's really interesting. And at the end, I'll ask you how people can get in touch with you, etc. But let's dive straight into what's happening with the economy, and let's start big picture. Recently, the USA employment figures have come out, as well as retail sales. Can you just give us an overview of what you're seeing in the US? Is it stronger for longer, or do you think we're going to see a little bit of a pullback?
Look, absolutely. We came into record highs towards the end of last year, Kerry, and just recently there was a number of key macroeconomic data that came out. So last month in the US, 199,000 jobs were created in December. That was on the back of 426,000 expected. So it was slower than expected. Retail sales rose by about 0.3% in November 2021, and they surged 1.8% in October. But there is some signs of a slowing domestic demand and faster inflation. And the biggest concern that we see is consumer credit. So that's the amount of money sitting on credit cards. And in the US, that's over $40 billion in December, which means that that's rising quite significantly above savings. And we saw the volatility index rise on the back of that 10-year bond rate. So there is a bit of volatility coming through, and the market's still a little bit nervous about the impacts of Omicron on the wider economy.
Niv, you mentioned the word that was transitory a short time ago, that inflation word. Have you got a view on that? Because, you know, sometimes they're talking about it and saying, well, first of all, they said it was transitory. Now they're not talking so much transitory. Is that going to have a bit of an impact on the global economy?
Absolutely. I mean, Goldman Sachs JBWE last week just came out saying that interest rates are probably likely to rise 4 times in the next year. And look, if interest rates rise, then obviously the cost of borrowing rise with it. The market's expecting 3 interest rate rises in the US this year. So look, if interest rates do rise faster than expected, then we'd expect that obviously savings will increase. The stock market may fall, but we will be looking at that US earning report coming through, and that's the key barometer following by the Australian reporting season next month.
What do you think is causing so much debt? You mentioned credit card debt, which did surprise me. I think you said $40 billion, because here in Australia, which we'll come to in a minute, we're paying off debt hand over fist, because I guess we're an island, we can't go anywhere, so people are paying things off. But $40 billion in credit card, what do you put that down to? What's driving that? And is that going to be an issue going forward, or will the government just keep handing out the funny money?
Yeah, well, we saw a big surge in the last 12 months on the whole buy now, pay later space. I mean, a lot of the younger demographic, in terms of the millennials or Generation Z, as they call it, are really happy to, take their wages and really, basically, instead of saving it like the good old days, going out and buying large ticket items, whether it is going out to bars and pubs and restaurants or buying, anything that they'd like on credit. So that is a concern, absolutely, especially given that they haven't been back in the 1990s when we saw it, Kerry, where interest rates actually were around 17, 18% at one stage. So, the younger demographic these days are accustomed to that 0.5, 1% interest rates. And we believe that if interest rates do rise 4 times, that's really going to put a little bit of a dampening in their pockets. So we are watching the whole millennial space and what impact that has on a number of sectors, whether it's retail sales or consumer confidence, business confidence, housing. But time will tell, absolutely.
Well, a lot of our listeners out there are around Australia. Let's pull it back into the Australian retail sales, which have had a very strong rise, and those November data has risen quite strongly. Coming into 2022, it looks pretty strong. And as I said earlier, people aren't traveling as much and they're not going out as much due to this Omicron, dare I say it. So there's a lot of savings going on. What's going on?
Well, think about this, Kerry. I mean, if for a young person, and we've got a few working at peak, and I'd say I'm young in my 30s, but the ones in their 20s, etc., have been stuck at home for 12 or 18 months, just want to get out. They want to, spend money. They want to go out and see their friends. They want to go out and drink in bars and restaurants and have a good time. So in November, we had a boom in retail sales, up 7.3 month on month, which the forecast was 3.9%. There is a little bit of a slowdown on the back in January, obviously, of what's happening with the whole Omicron. And analysts at ANZ are actually saying that the spending on the bank's cards for the first week of January sank to the lowest level since the Delta lockdowns. So we don't know the full impact that has on retail sales, but we will be seeing that in the quarterly reports, probably in that quarterly, not let's say in December quarterly, but more in the March quarterly reports and some of the outlook statements for a lot of these companies coming through.
Well, we mentioned inflation in the US, and we mentioned the potential of that no longer being transitory. Do you see inflation? And because I'm seeing it in everyday, it's not being spoken about it, though, is it, Niv? It's really sort of, let's put that under the carpet, not talk about it. But it's starting to rear its little ugly head. Now, that can be good and bad, depending on as investors, what you're looking at.
For those at home who don't know, it's really the price is rising, and a lot's been driven in the September quarter. There was a 3% rise in inflation, which is one of the highest it's been in the last 12 or 18 months. We've seen the Reserve Bank here in Australia traditionally want that 2 to 3%. So any inflation reading above 3%, we probably will start to see interest rates in Australia rising. And, the whole supply chain management's really being impacted. I mean, we saw 200,000 essentially transportation workers being impacted by Omicron. So no cars, no transportation, no airports. I mean, we're seeing also Ingham, which is one of the largest supplier of chickens in Australia. And, there's a huge shortage right now of chickens. And we've actually got an investor of ours that owns some KFC stores, and they're having a massive chicken wing crisis at the moment because they just can't get enough chickens coming through. So I think it's impacting across all verticals. It is a bit of a concern, especially in those, call it service-based verticals, rather than, you'd say your manufacturing and your education and transportation. And we think that is going to be a big problem over the next 2 to 3 months, especially for corporate Australia.
So you say it's going to be a big problem, Niv. I really want to try and dig down a little bit on that one and say, okay, if it's going to be a bigger problem, how do we as investors start to play it? What's that big problem look like, and how do we protect ourselves, I guess?
Yeah, look, I mean, stock markets here in Australia are going well. I mean, so we'll go through sort of our top themes for 2022 and our top picks shortly. But investors just need to be cautious. They have to understand that, interest rates are at the lowest levels that they've been on nearly on records. Cash is cheap. I mean, we've seen a big surge in buy now, pay later. We've seen inflation rise. We've seen retail sales at one of the highest figures it's been on record. And the US is near all-time highs. So, look, we are telling investors to be very stock-specific, sector-specific. And sometimes it is important to just take some money off the table. And for those stocks or placements, let's say with listed options, well, general advice only, you might take your profits over the heads of the stock and maybe just keep the options for upside. But there are ways to protect yourself, whether it is through gold or through diversification in the crypto market, or whether it is essentially buying options as put protection. You can do across the board, or even buying the volatility index as a bit of a hedge. But we like to be stock specific, sector specific, and our bread and butter is really identifying great opportunities that we back with our own capital, and there's a lot of them out there at the moment.
I want to go stock specific in a moment, but before I do, look, here in Australia, we're always talking about property. One of the largest property companies in the world over there in China, the big Evergrande. It seems to have gone a little bit quiet because there were rumblings last year that Evergrande was in trouble, and that potentially, if that had a collapse, the impact globally could be quite strong. Are you looking at China at the moment? Is that impacting at all, or is it all okay over there and nothing to worry about?
Look, China is obviously, used to be one of our number one trading partners before, essentially in the last 12 to 18 months has been, as we know, well-documented volatility. I mean, the Evergreen default in 2021 did pose some financial risks to the financial systems, but the key for China is really their bond market. And right now, they're really pushing down the bond prices and interest rates as much as they can. And the foreign holdings in Chinese treasury bonds have actually increased for 11 consecutive quarters and now stand at 2.4 trillion yuan, which is 11% of the bond market. So, look, we see a big risk in China. Obviously, we've seen, essentially the bond market and what impact that has as well on across the board in specific sectors, whether it is gold and iron ore and our seafood industry, our milk. So China is definitely a big brother to us, but obviously that volatility, we feel it's partly factored in already, but we don't know what we don't know. I mean, obviously, if there's going to be further defaults, if the bond market does evaporate, that will obviously hit Australia for sure.
Well, let's hope that it doesn't do that at the moment. I want to get into stock specifics at the moment. And you mentioned my favourite word, gold. I'm a gold nerd, Niv. Let's go into your top sectors going into 2022. And you don't have to say gold is, but let's go top sectors at the moment.
Look, we'll start with lithium. I mean, electrical vehicle demand, Kerry, has absolutely gone through the roof. The whole lithium-ion battery space is really exploding, and we've seen Tesla's stock price at the highest it's ever been. So look, there's a lot of money coming into the lithium stocks. We're actually listing a lithium company called Patagonia Lithium. They've got 4 tenements in Argentina, backed by great management, great board. We've just completed a seed round, and we'll be listing this company over the next few months. So look, really excited with Patagonia Lithium and essentially the capital structure, the management team, the assets that we've picked up. In the lithium space as well, Ascari Resources, AS2, I'm a bit biased, and I'm the number one shareholder, so I can be biased. So everyone has to take that with a grain of salt. But AS2 is another company that we IPO'd. They've got a number of gold tenements in Hori.
Yeah, that's what I thought. Are they lithium or are they gold, or are they both?
Across the board, Kerry, they've got lithium. They've got copper, and they've just came back with some really strong copper sampling results at Hori, which is over 8.5% copper. They've got gold. So look, we like the diversification of Ascari Resources. So for the lithium, let's say gold, Patagonia Lithium, which is an IPO that we're going to be listed, and Ascari in that space are probably number 1 and 2. Following on that, which is a little bit broader, is probably Castle Minerals. We completed a $3.6 million placement for Castle just a few days ago, actually, at 3 cents per share with a 1-for-3 option. And Castle have got a great suite of projects in Western Australia. One is right next adjacent to GBR, another one adjacent to Rumble Resources.
Oh, yeah.
They've got a graphite project, a lithium project in WA. So that's done exceptionally well for us. And we backed it again with $3.6 million only a few days ago as well.
What about one of my favorite, apart from gold, there's another favorite I've got, which is uranium. And, we've got a couple down here in Australia, such as Boss Energy, which is pretty, they can get up and running pretty quickly, run by the wonderful Duncan Craig. But Do you like uranium as a sector, and what do you see as its future, especially in this?
Love uranium. Love uranium, Kira. We're actually working on an IPO called Terra Uranium, which will list over the next month or two. That's backed by the ex-founder of Alligator, Andrew Viger. Also, Daryl Stevens as well, who used to run Cameco in Australia. Alaska as well in Canada will be the #1 shareholder. And Duncan actually invested himself. So look, we got some really, really strong interest. Tribeca came on board. A number of other family offices came on board in a small seed raise that we did. And then we're going to go out $7.5 million raise. They've got a number of assets. Kerry, right adjacent to 92 Energy and Alaska and Cameco in the Athabasca region. Some really, really strong assets. And look, one to keep an eye on. So that's Terra Uranium. But yeah, we think that uranium is going to be a huge asset class for 2022. We obviously saw some volatility coming through in Kazakhstan, and that's impacting some of the supply. So across the board, we believe long-term, with Sprott buying physical uranium in the market, we think that that's going to be a huge sector. So very, very strong in the uranium space and also the whole ethical division, ESG side of it as well.
Yeah, and I think it's important for people to understand that ESG side of it is, uranium is a clean energy, and there's so much focus on, that zero carbon. And if people can just get over the fact that the new technology for uranium means it's a very clean fuel source, and energy, I think, Niv, is going to be the word of 2022, because there ain't enough of it, and we're going to have to find new sources of it. So that oil, that gas, that uranium, all that energy sector, I think is going to be pretty interesting. And speaking of energy, green hydrogen. Now, I know you guys quite like that area. Is it a little bit too early for green hydrogen, or are you fairly confident in its future?
Great question. So green hydrogen, I mean, we've seen global, essentially municipalities and essentially the governments and companies moving to that zero net carbon emission. Now, uranium, as you mentioned, on a net gigawatt basis and power basis, they use the least amount essentially of power and resources than any of the renewables or fossil fuels. So look, we do like uranium, but going on green hydrogen, it is early. The cost is still high based on economically to make it viable. So that's why the price of oil and liquefied natural gas and coal are still going up. Yeah. But there is that reflection point as global companies around the world move to that zero carbon emission. So we've seen essentially two companies we like, Renew Energy and Line Energy. Stock code is RNE and LIO. RNE is just finalising an acquisition in a company that we're also invested in called Countrywide Renewable Hydrogen. And they've got a suite of projects in Australia and also overseas. And Line Energy essentially developed a really, really strong footprint in the mobility space. And they've picked up a relationship with the Wagner family, which control a lot of the airports and railways in essentially in Queensland. They've also got a number of other projects across the board, and the university also in Queensland. So look, across the board, we like the green hydrogen space, Kerry, but we do believe it's early. The key is infrastructure, pipelines, the cost, and to make it viable for the end consumer. So instead of you going out and buying essentially a Toyota, powered by hydrogen or hybrid for $80,000, that cost needs to go to around $15,000, $20,000 and electricity across the board to make it viable.
All righty, we're coming up to a couple of areas that I'm not that familiar with, but we spoke briefly about the circular economy, which I always go...
The circular economy is very wide, Kerry. It could be plastics, it could be hydrogen, it could be energy transition, right? It's all about the circular economy and where it's heading. And we think that's going to be a really, really big theme for 2022. Two companies that we really like in that circular economy, a company called Range International. The stock code is RAN. We completed a raise for that last year. We raised $3.6 million at 0.08 of a cent, currently trading around 1.9 to 2 cents level. Now, what they do very, very well is they take essentially your plastic. So think about any plastics that you have, they recycle the plastic and make pallets. So for those at home, everyone knows, obviously, there's been a big, big shortage of wooden pallets across the board, and timber prices are going through the roof. Yep. What I think Range has done really, really well is to recycle plastics and also now moving into other verticals. So they've got essentially a big plant. Companies like Unilever and PepsiCo and Coca-Cola are actually utilising Range's services. And we like the company. We think it's very cheap, and we're holding a big position. The second company that we're backing essentially the circular economy is a company called Timeless. And once again, we're large shareholders. We're number 2 shareholders. The stock code is TYM for those at home. And companies across the board, Kerry, we talked about zero carbon emissions, but how do these companies track and trace their emissions? And what Timeless has done is essentially developed in a real-time environment a platform to track and trace the carbon emissions on a minute-by-minute basis. They're currently undertaking a number of pilots. One is with the Queensland Government, one is with UON, which have got a relationship with Fortescue Metals, Rio and BHP. And if those pilots come into a binding contract, we feel that they're going to be in a really, really strong position. So Timeless and RAN, essentially in that circular economy, are 2 stocks that we really like.
That Timeless one, and by the way, it's kind of hard to understand. It's TYMLEZ, and the stock code is, what's the stock code again?
TYM.
TYM. So Timeless, are there other people doing something similar to them in that carbon space, or are they unique?
There's a company called Power Ledger. They've done essentially tracking and tracing more of their electricity. Timeless has got a platform that's patented here in Australia. There's another company essentially that has listed. I mean, for those at home, FTZ, in terms of the whole carbon capture, they're doing something a bit different because they're essentially going out and identifying land, and out of that land, they're generating the carbon. But Timeless is essentially a technology platform for the tracking and tracing of green energy units, including carbon. So what they're doing is revolutionary. We think there's a big addressable market as global governments and companies move to that zero carbon emissions. And there's no real opportunity for those companies to really report their emissions in a real-time basis. And we believe that's going to be mandatory coming through in 2022 and beyond.
Well, that's certainly, when you say about that reporting side of thing, I think that could be massive. So that's really interesting. And speaking of which, do you think, because you said it was a technology play, Niv, do you think, we've not a lot of time left, but do you think that some of these technology plays, and I'm talking the Teslas, the Amazons and a few of the others, do you think that they're a little bit overpriced in this economy? Because there is a little bit of, I guess, the wobbles, if you like, and a few people saying that there could be a bit of a pullback. Do you think that tech sector is a little overvalued at the moment?
Well, we've seen the tech sector, Kerry, fall by about 5 to 8% since its highs, and lots to do with the 10-year bond rates. And if you look at Zip Money and Afterpay and some of those companies as well, the technology company, Appen, et cetera, have fallen off. That's absolutely correct. Do we think that's overvalued? Look, probably, and there are opportunities. That's why for investors, we do like the small cap and nano cap space, because we can take bigger positions in our own deals and really influence the management teams a lot more. So companies like Timeless, like Range, like Renew, right, like Lion, like Castle, look, we've got that accessibility. So, look, I mean, we believe that the top end is probably overvalued, but there is value in that small cap, nano cap space, and that's why we're happy to accumulate on weakness.
Yeah, you know me, I love the small cap space. I want to touch on 2 more things. Gold, well, precious metals, I guess, your view on that, and also the metaverse. Oh, my goodness. Gold. I'm not of the right, what's the word? The right age group to even fully understand what this metaverse means, but I know it's big, it's coming, and there are investment opportunities. So I want to talk about that, and then I want to finish because I'm the gold nerd on gold and precious metals. So let's go metaverse first.
So augmented reality, virtual reality has been around for a long time, and it just needed that extra kick with Facebook changing its name to Meta. Now they're calling it Web 3.0, which is essentially a blend of Total Recall with SimCity. And look, the whole ability to escape your life into a new world called the Metaverse. That Metaverse is just unbelievable. I mean, someone paid, Kerry, $650,000, right, leveraging their cryptocurrencies to buy a yacht that they can't physically use. I mean, it's just amazing what's actually happening in the whole Metaverse. And that space is just going to get bigger and bigger and bigger. There's huge amount of money going to the metaverse. Investors are buying essentially digital assets like real estate, utilizing tokens, essentially to watch Justin Bieber, or even buying a Paris Hilton handbag. So that whole metaverse NFT space, we believe, is going to be a big buzzword for 2022. And one company we are actually looking to back is it's a private company called Tag Space, and we're looking to launch a token. So watch this space.
Tag Space, watch this space. Righto, come on, Niv, give me a little bit of feedback on what you think on the precious metals area.
Oh, look, we love precious metals. As I said, whether it is Castle, whether it is Ascari, I mean, gold is not going away, Kerry, as you know. Inflation pressures, we talked about inflation, is still going to be here to stay. And we're seeing some movements in the gold price. Do we see $2,000 an ounce this year? I think the answer is yes. As the US interest rates start to rise, the Reserve Bank starts to increase interest rates, investors will be looking for safety and a bit of that hedge, and gold is the place to be. So we do like gold. We do have an exposure in gold, and we think that's a great way as a form of defensive assets to pick up as a bit of a hedge for investors' portfolios. So absolutely.
And especially at the moment, ladies and gentlemen, when those gold share prices have had a little bit of a pullback, it's do your own research. This is not financial advice, but definitely time to take a look. All right, Niv, the way I always like to end these, give my wonderful community out there 3 pieces of advice as we head into 2022 about best way to protect, but also to grow their wealth.
Yeah, look, it's going to be volatile this year. Always, keep locking profits, locking profits on their heads. And if you do have some listed options where you've got that for upside, and you may leave some money on the table, but it is important to take some money off the table and don't get greedy. Number 2, protect your gains. So whether it is stop losses, whether it's hedging, whether it's diversification into other asset class, and always back the right management team. I mean, management is everything. Inside ownership, skin in the game are critical. Capital structures. So really, really appreciate Kerry being on the show today. Really enjoyed it.
Niv, just before you go, how can people get in touch with you if they'd like to find out, first of all, more about Peak Asset Management, or perhaps they want to pick your brain?
Yeah, we've got essentially a morning wrap and an afternoon wrap that goes to around 25, 30,000 investors. So we do a lot with small caps. We love what you guys are doing. So for those at home, www.peakassetmanagement.com.au, and you subscribe to our free newsletter and a morning wrap and afternoon wrap and get access to the deals. Very accessible, a small team. And for everyone at home, 2022, it's going to be volatile. It's going to be lots of fun. So look forward to riding the waves and making some money together.
Good on you, Niv. Thank you so much for joining us on Small Caps today. And you heard it from Niv. It's going to be a volatile year, but perhaps a little bit of diversity, a little bit of caution as we head into 2022. Thanks for joining me on Small Caps today. We'll see you next time.